months ago, I had the opportunity to chat with President of WindRock Wealth Management to discuss the classification of gold and misnomers related to the trading and investing world around gold. Today, I'm joined by Managing Director of WindRock, Chris Casey, to take on the topic of inflation. Chris has addressed crowds across the country on laissez-faire styled wealth management and what it takes to financially succeed in the financial climate we are in today. Thanks for joining me today, Chris.
Well, thank you, Megan. Happy to be here.
So today we're covering the topic of inflation, and before we get started, I think it'd be great for our audience if you and I define our terms. So Chris, as an Austrian-leaning economist, what is the definition of inflation?
Well, most Austrians actually use the classic definition of inflation to mean an increase in the stock of money within society. And while that's completely accurate, and I agree with it, nowadays the nomenclature has come to mean something different over the last 40, 50 years. And it's come to be associated rightfully with an increase in the price index in general. So for our purposes today, if I mention inflation, usually I would caveat by saying price inflation, but today if I say inflation, I'm really just meaning an increase in the price level in general. And by deflation, it's the exact opposite. It's a decrease in the price level.
Free market enthusiasts that are listening, we're not denying the definition from the Austrian school.
Absolutely.
So before we get started down a lot of the myths around inflation and how people are incorrectly defining and describing inflation in today's current climate, business and political leaders tend to think that the country is impervious to a lot of economic law. And the dollar has strengthened this year, and a lot of people are rallying behind the dollar. But to get started, how is it that the dollar is being seen as strengthening? What is this compared to, and how is this strength even measured?
Sure. Well, when people hear about the dollar increasing over the last, I guess it's almost been a year now. I think it was July of last year. What they're really talking about is a trade-weighted index of the U.S. dollar relative to other currencies. And primarily because of that, you're talking about our trading partners. So you're talking about the euro, you're talking about the yen. And it's true, the dollar has risen about 20% relative to those other currencies. But it should be remembered, all of these currencies are backed by central banks that are performing horrible practices as far as increasing their money supply. So whereas the U.S. dollar appears better and has appreciated against those other currencies, it doesn't hide the fact that the U.S. dollar is in a precarious position for the long term, despite how it's measuring up to other poorly managed currencies around the world.
The next topic I did want to jump into before we get into the myths around inflation, many of which come from the Keynesian side of economic study. Let's talk about the supply and demand for money and how there's a lot of confusion around the price level and setting prices for money.
Sure. It's amazing. Pretty much every economist out there in the world would agree that for any good or service, its price is effectively a function of the supply and demand for that good or service. I mean, pretty much everyone would agree with this. And what's striking is that when you apply the same concept to money, which Austrians do, somehow other economists don't agree. Now, for some reason, money, we admit, is different from other goods, but it's not magical. It's not completely, it still has the same forces of supply and demand acting upon it. So ever since 1912, when Ludwig von Mises published a theory of money and credit, pretty much every Austrian has understood that the price level is a function of the supply and demand for money. And it's conceptually, I think it's pretty easy to think about in those terms. If you increase the supply of money, you cheapen the currency, meaning that prices go up and the dollar's worth less. If you increase the demand for money, meaning people want to hold larger cash balances in the economy, well, that's creating a downward pressure on prices. Think about it as if you want to hold money while you're having that garage sale, you're trying to sell assets in a frantic bid to increase your cash holdings. So increased demand has a negative effect, a deflationary effect upon the price level. And thought of in those terms, money and the price level becomes a pretty simple concept to understand. And unfortunately, society is riddled with myths about what really causes inflation, what causes deflation. And while that's going to create tremendous problems for society in general, it's a great opportunity for potential clients of Anthem Vault, because what right now, in order to protect yourself, there's some really cheap assets and cheap investments you can do, and you're the only ones you're correctly perceiving when the inflation will hit and its magnitude, whereas mainstream economists don't see that.
That's right, and it's funny that you note that economists are no longer agreeing on certain things like setting price levels, basics of economics like supply and demand. It's almost as if economic law is no longer relevant in mainstream economics and politics.
Well, certainly they're at least misinterpreting or correct economic law is not adhered to. And what's really striking is that while everyone pretty much adheres in the mainstream to this Keynesian concept, the Keynesian school of economics, their theory of inflation or deflation, to the extent you can even call it a theory whatsoever, is completely debunked by reality, specifically the 1970s. And so what we had there in Keynesian economics, it should be remembered that it's impossible to have price inflation during a weakening economy. So if you have a slack labor markets, if you have a recession and there's so-called overcapacity or excess capacity within the economy, it's impossible to have inflation under their theory, because aggregate demand, for whatever that is no longer outstripping aggregate supply, however you would measure either of those. And in the 1970s, what we had economic weakness, broad-based and deep, and yet we still had staggering amounts of inflation, and specifically during two periods, the middle and then late 70s. So that should have put a fork in the theory of Keynesianism in general, if not just their theory of inflation. And what's interesting is, when they were retreating from this theory and when they were trying to come up with an excuse as to why they weren't really wrong, they dusted off a 1957 concept called Costpush Inflation, which I think is even more ridiculous. And this is the theory that, okay, even if you have economic weakness, if you have some commodity or some good or service that's so pervasive throughout the economy, if it has a particular spike in its price level, it will increase prices throughout the board. And so what they were pointing to, of course, in the 1970s was oil. They said, well, hey, oil is used in plastics. It's used as a feedstock for a lot of things. It's used for transportation. If oil increases, then, of course, the price level is going to go up. But again, that flies in the face of basic Austrian theory of the supply and demand for money being the only thing that dictates the price level. And not only is their cost-push inflation theory debunked by, again, facts, but it doesn't make any sense conceptually, because if you have to spend more money for oil or its derivatives, gas, etc., well, you have less money to spend on anything, which puts downward pressure on those goods and services. So the price level in general should be unaffected by any particular good going up. And, just to really drive home the point about this concept, you could just look at oil. What's oil done in the last, let's say, 10 years, right? So I have the numbers right here. Oil was at $25 in 2003, went up to $133 in 2008, went down to $40 in late 08. And then back up to 125 in 2012. And now, of course, we're testing the 08 lows again. I mean, does anyone really think that our price level has increased and decreased with the gyrations in oil over that given time period? And yet oil is just as important as it was in the 70s.
Right, that's right. Not to veer off too much from the topic of inflation, but the sentiments that you're bringing right now remind me a lot of this minimum wage debate that's going on at the moment. Just this general misunderstanding of the fundamentals of economics at the moment. So what kind of effects can you see the raise of minimum wage having on places like New York?
Well, it's funny that you say that this whole debate about the price level and what causes inflation and deflation, kind of mirrors these issues as far as the minimum wage. I guess it ties in two ways. One, again, most economists agree that the supply and demand dictates the price of any good or service. Well, most economists also agree that price ceilings and price floors create shortages or surpluses. And certainly when you have a minimum labor rate for any given position, you are going to cause unemployment. I mean, that's just an economic fact. And as relates to, and here's another inflation myth that's directly paired in with this, is that when people talk about, well, you're increasing, the wage rates for some given labor market, that's going to have an inflationary spike. Well, no, this is the cost push inflation theory again. Just like oil doesn't affect the price level in general, any particular wage or labor level increases will not have the same impact on the price level as well.
Right. Using empirical or anecdotal examples doesn't defeat the economic law behind supply and demand.
Absolutely, and they should really know this out east, because and the West Coast, I guess, they have suffered for years over rent controls, right? And so what do you have? Well, you have a horrible shortage of space for people to live. I mean, it's the same exact economic law that we'll see as applied to the labor markets.
This mainstream perspective on inflation and deflation, they tend to be myths. And I know you have a really great way of explaining all the myths and kind of debunking this mainstream idea about inflation and deflation. So please, Chris, take it away. We'd love to hear your thoughts on it.
Yeah, let me describe maybe 4 myths that I think are pervasive and out there. And I've kind of already alluded to 2 of them, which are classic Keynesian ideas. And so the first being is that somehow you hear about this overheated economy. And by the way, whenever you hear an analogy like overheated take the place of an argument, I mean, that pretty much guarantees the argument's wrong, because anyone that argues, the only way to have inflation is to have an overheated economy clearly probably doesn't know what they mean by overheated economy. But what they mean is that, the labor markets are heating up, there's very little capacity left, manufacturing capacity, et cetera, and therefore producers are somehow going to raise prices. And this doesn't comport with economic reality from the 1970s, which I mentioned, or common sense. And so then the second myth would be the cost push, which we mentioned, whether it's labor, whether it's oil, what have you. Any single given price of any single given economic good or service cannot increase the price level for society as a whole. The third one, which is coming up quite a bit, and I think it's a little more difficult to understand, but it's just as pervasive and it's just as damaging, is this concept of velocity. And so this is even beyond the Keynesians. This includes what remains of the Chicago School of Economics. And these people believe, okay, let's say we've increased the money supply quite a bit. Well, if that money's not circulating quickly within society, somehow that's keeping a lid on price inflation. And in reality, velocity is meaningless. And it all derives from this old equation from 100 years ago by Irving Fisher called the Fisher equation of exchange. And it basically just says that the money stock out there, the number of times it circulates equals the prices out there times their transactions. And this is kind of a silly equation because it's obviously true. The left-hand side has to equal the right-hand side. The problem with it is that in that equation, you'll notice there's nothing in there about demand for money. And again, going back to what causes the price index level is the supply and demand for money. And so to have an equation that purports to discuss what the price level causes the price level and not to have monetary demand in it means it's a faulty theory. And from that, we realize that velocity is not a proxy for demand. If anything, maybe it's a proxy for overall volume. And, I think an analogy of the stock market's a pretty good one. You can see a stock market at any given day that the number of shares doesn't change that much, so the supply doesn't change. But the overall price level of the stock market changes a great deal due to demand. Well, you can have demand that skyrockets and the price index or the stock market index goes up, or it could be very low. And being high or low has nothing to do with the amount of trading. The trading could be very small or it could be very high. And the same thing with monetary velocity. It has no bearing on the price level. So that's another myth that's out there. And what's dangerous is that if people really think this is keeping a lid, or if policymakers think it's keeping a lid on inflation, they're going to be surprised when things turn around. And maybe I'll just mention one last one here. It's a myth that relates to, I guess, deflation. I hear a lot of people talk about, well, Japan's population is aging and somehow demographics are going to collapse their price level. And that's another myth because it has nothing to do with the supply and demand for money. Mm-hmm. And what they're really saying is that there's some kind of credit bubble that's built up, and when it collapses, there's going to be some ensuing deflation. Well, a collapsing credit bubble, if it's built on fractional reserve banking, may indeed lower the overall supply of money, but just demographics alone have no bearing on the price level.
Yeah, thank you so much for listing out and debunking a lot of those myths around inflation. So with gold bugs, with the Austrian school, with free market thinkers, we're constantly preparing for a inflationary period. We've seen plenty of inflationary periods in the past as well as currently in countries across the world. So what is it that's going to tick, that's going to make this inflationary period begin? Because, I mean, even economists like Robert Murphy and other people from the Mises Institute will say, yes, we know it's coming. No, we don't know when.
We absolutely don't know when. But in some ways, I think that's less relevant because we know the magnitude of how great this change is going to be. And so that's the most important thing, right? Knowing which way the dollar is going to turn and how greatly it's going to go negative. That's far more important than timing in my perspective. But as far as, what's the incident or what's the causation? I guess I could see three potential areas, and two are on the supply side and one is on the demand side. On the one hand, to the extent that the U.S. dollar continues its erosion as the reserve currency for the world. So to the extent that foreigners are less willing to hold dollars outside of the U.S. and those dollars come home, that's going to increase domestically the supply of money. So although the supply of money may be X trillion of dollars, if a lot of it's held overseas and not being bid on American goods and services domestically, it's not really increasing the supply of money. And so therefore, when those dollars come home, that's going to be a hugely negative impact on the U.S. dollar. Another item related to that concerns the excess reserves that banks have with the Federal Reserve. So, if banks start really lending out these reserves that they have there, I think that's a huge inflationary effect upon the economy. And the reason being is because of fractional reserve banking, every loan that's based on demand deposits that's made ultimately is really increasing the supply of money. So the banks have the wherewithal right now to increase the supply of money in the U.S. If they start doing that, it's going to be horrific times for the U.S. dollar and the American consumer. And then lastly, I'll mention on the demand side, to the extent the U.S. dollar ceases to be seen as some kind of safe haven, which it is right now, but to the extent people start being nervous about the U.S. dollar and start dumping their dollars, whether it's in exchange for precious metals, certain types of real estate, cryptocurrencies, foreign currencies, who knows? But to the extent that that trend continues and people become more and more wary of the U.S. dollar, that monetary demand factor will have a horrible impact upon the price level, meaning prices will skyrocket when people no longer want to hold the dollar. So what can spike inflation? I think all three of those can, and I think they will in some level sequentially, the demand side being the last one affected. There's some real danger signs out there for the U.S. dollar, and when it shows up, I can't say when the price inflation will show up, but I know it's going to be ultimately going to be quite devastating.
Right, and on the other side of that, is there a way to prevent this spiral into inflation? Because we've seen similar times like this in history during the 1970s, the Great Depression. As we know, there's been a lot of talk within the Federal Reserve on increasing interest rates at the moment. I personally, from what I've read and the rhetoric that's been put out by Janet Yellen and other Fed presidents, I don't see a 20% increase in rates anytime in the future. They're talking about the smallest of small increase in rates. So we know that's not going to avoid some inflationary spiral. But is there anything that can?
Well, I guess let me answer your question in two ways. One would be theoretically, what can be done to stop this inevitable price inflation that we expect based on what the Federal Reserve has done since August of 2008? And from that theoretical perspective, I don't know. I mean, they can certainly theoretically do measures that would create deflation and try to counteract their inflationary policies of the past. But I don't know if it's enough. I mean, in some ways, I think once you've administered a lethal dose, there's no antidote. And I think we may be beyond that. Even if we have a brief period of deflation, we may have so much money created in the system that it won't matter ultimately. So that's from a theoretical perspective. I guess my answer is I'm not really sure. From a political perspective, though, which you alluded to, I think it's impossible to stop this. I mean, what they've done, you're right. They can never raise rates as high as they theoretically would need to even put a dent in the future price level. I just don't see it politically. It's a non-factor. They will not be able to address it, either A, address it, or B, address it on a timely basis.
Right, and I absolutely agree. It seems like a bit of a pessimistic view, but it is very realistic. And knowing that is what lies ahead, because there's no putting the toothpaste back into the tube at this point. You find places like Anthem Vault and WindRock being these hard money-based avenues for people to take because, like in what you just said, and in my opinion as well, there is no going back at this point. The beast has been built far too big, and at this point it's almost, hold on to hard assets if you can, be able to ride it out in some way, shape, or form.
I completely agree, and I really think things are going to get far worse than they ever were in the 1970s, and I'm much older than you, but I remember as a kid in the 70s, and it was bad. And I would not be surprised if we have a repeat that's far, far worse.
Yeah, I'm interested in hearing about your experience during the 70s, the significance of the inflation. Is it anywhere near what we're seeing today? Obviously, on a consumer base right now, no one's really feeling inflation, but it is happening. It's in our system at the moment. But was it anywhere near like it was in the 70s?
Well, not so far, but I think it will be. And just to put the 70s in perspective, and this is a good lesson about history, a good lesson about inflation as well, is that when people sit, these mainstream economists, and they sit on the news and they're offering prognostications of where they expect inflation to be, and oftentimes they'll sit there and like, well, I just don't see it. I just don't see the price inflation. Well, the problem is that when you do see it, you're going to be looking in the rearview mirror because it comes on quite suddenly, and that's the experience of the 70s. So, the last link to gold was severed, as everyone knows, in August of 1971, and everything seemed fine for a while. In 1972, inflation was, even by those standards, somewhat tame at about 3.2%. But that was the last time for the next, I think, 9 or 10 years that the inflation rate was ever below 5.8. And we had periods where it was in double digits. So 1974, 75 were at or above 10%. In 79, 1980, 81, you're well above 10%. So it could be devastating. From my own personal memory, and I was a kid, but you remember everyone talking about it. You remember politically these stupid programs they had, like Whip Inflation Now, and you remember its impact on interest rates, which were skyrocketing, and people couldn't afford homes. So, inflation has been bad historically. It's been bad for the exact same reasons that are occurring right now. We just haven't seen the ultimate repercussions as of yet.
Right, and there's the myth also that the Federal Reserve can control inflation, because if anything, all they can do is contribute.
Yeah, well, you're dead on with that being a myth about the Federal Reserve somehow being this protector of the price level. I'm surprised I didn't write that one down. It's almost comical when you really understand what causes inflation, that and I think they have some inkling, that they can honestly hold themselves out publicly and say they're position themselves as these guardians of the price levels, stable prices. And yet, in truth, they're really the only entity that can create and cause inflation in collusion with the banks, of course. But they're the primary and sole entity. And so 2-3 years from now, who knows, when we have massive inflation and they're on the news complaining about, the oil barons or, foreigners, or that's what Nixon did when they severed the gold standard, right? It's the money speculators, I think the term he used. When we see that next, you'll know, no, they're deflecting. They're the ultimate problem.
And Chris, thank you so much for your time today. I think we covered quite a bit of meaty topics here with inflation. And for those of you who have been listening, I will happily be listing up the 4 to, I think we ended up covering about 5 myths regarding inflation and deflation here in the U.S. and what central banking is doing to our financial climate. Thank you so much for your time today, and looking forward to talking to you guys in the near future.
Great. Thanks, Megan.
All right. Have a great one.